Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down the best Canadian dividend stocks to invest in 2020 during the current market crash and beyond. In this video, I'm only going to be talking about dividend stocks in Canada. I'll be making a separate video on the best US dividend stocks and the best growth stocks. I picked these stocks because they all pay a generous dividend, they have a long history of increasing their dividends, they are staples of the Canadian economy, so they will continue to keep earning money even during this market crash and the possible recession. And finally, I picked these stocks from different industries, giving you a diversified portfolio of the Canadian market. These are stocks that you can hold onto for life and collect that passive income every month or every quarter. And now is an especially great time to buy these stocks at a huge discount, around 30% off. Make sure you check out my last video on how to invest during a stock market crash. So click the pop-up at the top right to watch that video first before you jump into investing. Basically, now is not the time to panic and start selling stocks. It is an incredible time to buy these high-quality stocks at a huge discount. But before you put a single dollar into the stock market right now, make sure you have enough saved up in your emergency fund, especially if you're worried about having your income reduced or even losing your job in the next few months. Also, in this video, I'm going to be breaking down exactly why I think these stocks are great choices to invest in. So I'll be talking about things like dividends versus capital appreciation, dividend payout ratio, and the amount required to qualify for a DRIP. If you need a refresher on these dividend basics, then click the pop-up at the top right to check out my playlist, The Dividend Investing Guide, and then come back to this video. So without further ado, let's jump into the best Canadian dividend stocks to buy in 2020. Let's start with one of the best dividend investments in the world. BMO, the Bank of Montreal, with ticker symbol BMO.TO. BMO is one of the largest companies in Canada. It is the fourth largest bank, and it is the oldest bank in Canada. It has been around for over 200 years. Honestly, you can't go wrong with any of the big five banks in Canada. Royal Bank, TD, Scotiabank, BMO, or CIBC. They are all world-renowned banks and investments due to their security, their reliability, and their strict regulations, especially compared to some of the big US banks. If you saw my past video on my top 3 Canadian dividend stocks of all time, you know that TD is my overall favorite bank stock, and I still agree, even during this market crash. But I can't keep talking about TD every video, so my second favorite bank stock is BMO. In fact, a lot of the reasons why I love TD stock are true for BMO as well. I think that TD has the greatest growth potential of any bank, mainly due to the fact that they have been expanding into the United States, and BMO is following a similar strategy with great success so far. Another reason why I love BMO, especially right now, is that BMO is not very reliant on the housing and mortgage market, especially compared to other banks like CIBC, which are heavily dependent on mortgages, which is not the best place to be during a possible recession. Don't get me wrong, CIBC is still a great investment to make. I just think that BMO is a little bit better. Due to the recent drop in share price, BMO is currently paying out an astounding dividend of 6.3% paid out every quarter. You can buy this stock for a 34% discount off its regular price just a few weeks ago. The price has dropped by 34%, but the dividend remains unchanged, which is why the dividend yield is so high right now. My normal rule of thumb is that any dividend above 6% is probably too good to be true, but not in this case. Even with such a high dividend, BMO still has an extremely low dividend payout ratio of 47%, which is amazing. This means that BMO only pays out 47% of its profits out as dividends, leaving 53% of its net income to reinvest in itself and grow as a company. Here's an amazing fact. BMO has never missed a dividend payment in almost 200 years. BMO has paid out its dividend every single quarter since 1829. Even through World War I, World War II, the Great Depression, the dot-com bubble, the housing market collapse of 2008, BMO has always paid out its dividend. Even better, BMO increases its dividend almost every single year, which is exactly what you want from a long-term dividend stock, especially during a market crash. Also, because of the reduced share price, it is now easier than ever to qualify for a DRIP with BMO. Remember, a DRIP allows you to reinvest your dividend and buy yourself more shares of a company rather than receiving cash. And the best part is, you don't pay any commission at all when you use a DRIP to buy extra shares. This is the best way to invest in the long term, allowing your dividends to compound automatically, giving you true exponential growth. In the case of BMO, you only need $4,200 right now to qualify for a DRIP. With a dividend yield of 6.3%, our $4,200 investment would give us $264 a year in dividends. or $66.15 every quarter. BMO currently has a share price of $66, so every 3 months, our dividends will allow us to purchase a new share of BMO for free, and then we receive the remaining 15 cents as cash. Remember, this drip amount of $4,200 is so low because the share price is so low right now. Once BMO stock recovers and returns to its normal price, the amount required to qualify for a drip will also increase to around the $8,000 range. To find out how I calculated this required amount to qualify for a drip, click the pop-up at the top right to check out my video on drips, where I go over the long-term benefits of drips, and I provide a useful Excel spreadsheet that you can use to calculate the drip amount for any stock. Looking at the stock chart of BMO over the past 20 years, you can see a very clear and strong upward trajectory. In the past 20 years, there have been 2 significant drops. A huge drop this past month, and a big drop during the 2008 housing crisis. But you can see that BMO was able to recover in a matter of months, and continue its upward climb, all while paying a generous dividend along the way. And number 2, let's move on to another industry which performs well even during a recession, and that's utilities. My favorite utility stock right now is Fortis, ticker symbol FTS.TO. Fortis is one of the largest utility companies in Canada, and it provides the transmission and distribution of electricity and natural gas to over 3.3 million homes and buildings in Canada and the United States. This is the poster child of a strong dividend company because no matter what is happening in the world, whether it's an economic boom or a recession, people will need their gas and electricity. And so a company like Fortis will always be profitable and continue to pay consistent and increasing dividends year after year. Fortis is currently paying a great dividend of 3.8% paid out every quarter. The price of Fortis stock dropped a bit by around 13%. So even when things return back to normal, Fortis still pays out a great dividend yield of 3.5%. Like BMO, the best thing about Fortis is its consistency. Fortis currently has a super low payout ratio of only 48%. That means that only 48% of its profits go out to investors, leaving 52% of its profits to grow as a company. Here is a really cool fact. Fortis is number 2 in the list of Canadian Dividend Aristocrats. A Dividend Aristocrat is a company which has increased its dividend every single year for at least 25 years in a row. This is a difficult feat, and there are only a handful of Canadian companies that have done this, but Fortis has increased its dividend for 46 years in a row. It is just behind Canadian Utilities, who has a 48-year streak. So in a few years, Fortis and Canadian Utilities will become the very first dividend kings in Canadian history, meaning that they have increased their dividend for 50 consecutive years. That's incredible. So how much do you need to invest in Fortis to qualify for a drip? With a share price of $50 and a dividend yield of 3.8%, you'll need $5,300 to qualify for a drip. Let's check it out. The 3.8% yield will give you $201 in dividends every year, or $50.35 every quarter. That's enough to buy yourself a free share of Fortis every 3 months without paying any commission. Looking at the stock chart over the past 20 years, you can see a remarkably consistent upward climb. This is definitely a defensive stock. It almost never drops in value. Even during the last market crash of 2008, it barely had a noticeable dip, and it always recovers in a matter of months. Hold this stock for 20 or 30 years, and you'll be able to sell it for great capital gains, all while collecting that passive income year after year. At number 3, let's move on to the real estate sector with a REIT called Allied Properties, ticker symbol AP.UN.TO. Remember, a REIT is a real estate income trust, and they are a collection of hundreds or thousands of properties packaged together as a stock. And the dividends of these REITs come from the rent earned from these properties. A lot of REITs which focus on retail properties like shopping malls or plazas have been hit very hard by this current state of emergency since stores are closed to the public. Allied Properties, however, hasn't been affected that much because instead of retail properties, Allied focuses on offices and urban workspaces, especially in cutting-edge, high-tech companies. These are some of the fastest growing companies in Canada, and so the rent and the value of these offices will continue to increase. Allied owns a lot of the biggest tech hubs in Toronto, Waterloo, and Montreal. The building I work in, along with the new Google offices in downtown Kitchener-Waterloo, are owned by Allied. And so I know that the value of this REIT will continue to grow hand in hand with Canada's booming tech sector. Allied currently pays out a generous dividend of 3.7%, but the best part is that they pay out their dividend every month, not just every quarter. So with Allied, you'll receive 12 dividends every year, whereas most stocks only pay you 4. That's because REITs make their income through rent, which is collected every month. And so as an investor, you get a portion of that monthly rent. One of the best things about Allied is that they have an incredibly low payout ratio of only 28%. So they pay out 28% of their profits to you through dividends, and so they get to keep 72% of the profits to buy even more property, which allows the company, and thus your stock, to grow further in value. All this extra spending money allows Allied to increase their dividend every single year, and they've done so for the past 10 years. And with such a low payout ratio, even if something catastrophic happened and their profits were hit hard, they would still be able to afford dividends and continue to increase them every year. Since Allied pays out a monthly dividend, the actual dividend amount you receive each month will be smaller than the other stocks on this list, and so it will require a larger amount to qualify for a monthly drip. With Allied, you'll need to invest $14,600, which is a lot. With a dividend yield of 3.7%, that gives you $540 a year in dividends, or $45 per month. That's just enough to buy yourself a free stock of Allied every single month, commission free. That's 12 free shares every year. Looking at the stock chart over the past 20 years, you can once again see a very clear upward trajectory. There have been a few drops along the way, such as the housing market crash in 2008, but every time, Allied was able to recover within 16 months, and every month along the way, investors continue to earn that passive income. I should note that with all of these stocks in this video, you should hold them in your TFSA, and if that's maxed out, then hold them in your RRSP. That way, you won't pay any taxes on the dividends you receive or on the capital gains you make when you sell these stocks. These tax-sheltered dividends will allow your investment to grow much faster than they would in a non-registered account. This is especially true for REITs like Allied or RioCan, which are not considered eligible dividends. And so you would pay higher taxes on these dividends than you would for BMO stock, for example. So make sure to keep your REITs in a TFSA or an RRSP to avoid this tax entirely. Check out my video on how to invest in your TFSA to learn more about how to minimize your tax bill and maximize your long-term growth. Finally, at number 4, let's move on to the telecommunications sector with Telus, ticker symbol T.TO. Telus is one of the 3 telecom giants in Canada, along with Rogers and Bell. These 3 companies hold such a strong monopoly on the Canadian telecom market that I don't think it's ever possible for any new or outside company to ever compete with them. And that means that Telus is never going away. Telecom companies are very similar to utility companies in the sense that they are always in demand. No matter what is happening in the world, people will always need access to the internet and mobile devices. And the demand for this technology will only continue to grow with each generation. So a company like Telus will always be profitable, and thus they will always be able to pay out consistent dividends and increase these dividends year after year. Telus is currently offering an amazing dividend of 5.5%, paid out every quarter. Telus normally pays out a generous dividend, but over the past month, the stock price has dropped by over 20%. This is a huge discount for a blue chip stock like this. The reason why I choose Telus over Rogers and Bell is because of its consistency. Telus has a great payout ratio of 76%. That means that 76% of its profits go out to investors, leaving 24% of its profits to reinvest in itself as a company. This extra spending money ensures the security of its dividends. In fact, Telus has increased its dividends every single year for 16 years straight. That's exactly what we look for in a long-term dividend stock. With a current share price of $21.50, you will only need $1,600 invested in Telus to qualify for a drip. With a yield of 5.5%, that $1,600 investment would get you $88 a year in dividends, or $22 every quarter. That's enough to buy yourself a free share of Telus every quarter. Plus, you'll get 50 cents in change. For every $1,600 you invest in Telus, you'll earn yourself a free share every 3 months. Of course, as the stock price bounces back up to normal, the required drip amount will go up as well. But even if the stock price reaches $29 a share, which is higher than its all-time max, you'll only need $3,000 invested to qualify for a drip. That's great. So you only need $3,000 invested in Telus, and then you could sit back and watch your investment grow and compound on autopilot. Looking at the stock chart over the past 20 years, you can definitely see some ups and downs in the early 2000s. But after the emergence and popularity of smartphones starting in 2009, you can see a clear upward trajectory. If this trend continues, we can expect to see considerable capital appreciation, all while collecting those increasing dividends year after year. For all of these stocks, make sure you are buying them on the Toronto Stock Exchange in Canadian dollars. All of them, except Allied, are cross-listed on the New York Stock Exchange in US dollars. So to avoid paying unnecessary currency conversion fees, make sure you include the .TO in the ticker symbol to ensure that you're buying it from the Toronto Stock Exchange. If you're not sure how to actually buy these stocks, click the pop-up at the top right to watch my Questrade tutorial, where I give a step-by-step walkthrough of how to buy stocks and ETFs using Questrade, my favorite online broker. And if you'd like to get started with Questrade, click my referral link in the box below, and you'll get $50 in commission-free trades when you sign up. That basically means that your first 10 stock trades will be commission free. That saves you $50. Plus, I'll get a small referral bonus as well. So there you have it. Those are my top 4 best Canadian dividend stocks to invest in 2020, especially during this market crash. BMO is currently offering the highest discount and dividend yield with a huge potential for growth. Fortis is the most consistent stock here with dividend increases every year for 46 years straight. Allied Properties allows you to dip into the real estate market while collecting monthly dividends. And Telus allows you to take advantage of drips with only a small investment while still increasing dividends every year. Thanks for watching, guys. Be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel. And hit that bell icon to be notified by new videos every week. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. And I know I've been talking about this for weeks, but be sure to tune into my next video where I will finally be breaking down what is an RRSP and how to invest in your RRSP to minimize your tax bill and maximize your long-term growth. Thanks everyone, and I'll see you guys on the next episode of the Canadian in T-shirt. Bye guys.